I guess a few days.
Yeah, but as a
We have an expert, Ricky Singer. He's with
benchmark lending.
Benchmark. It's been a challenging time. I'm sorry.
That's
Smart lending. He's going to discuss with us some of the options you can have as a refinancing as a homeowner or property owner. All right, here you go, Ricky.
okay. Thank you, Clarence. Hello, everybody. I hope everyone is doing well and feeling well in these difficult times that we're facing. Seems to be talk these days on a couple of different topics. One, of course, unfortunately, is the pandemic that we're dealing with, the coronavirus, and how it's affecting people's jobs and livelihoods, lifestyles, et cetera, and refinancing mortgages due to the rates being almost at historical lows at this point. So that's why we wanted to do this for you folks and give you an idea as to what the markets are, what the market conditions are, and why it would be a good time for some people to refinance their loans. So basically, as I said, we're almost at a historical low. Rates have been very volatile since the pandemic started. But mortgage refinancing is still something that people, depending on their needs, should be doing at this point, depending on their needs and depending on where their current interest rates are. That will guide people and help to decide whether it does make sense or not. So right now, in the mortgage market on a refinance, there are basically three reasons, and there always have been the same three reasons pretty much for people to refinance their loans. One of which is, for the most part, is to reduce their monthly payment. I would say that probably accounts for 50 to 60% of all the refinances done out there. I don't have those statistics, but in my experience, I've been doing this for almost 30 years, that seems to be the case. So when interest rates are lower, people have higher rates, they can do this by saving money by refinancing their loan. The other two reasons people refinance their loan is to also reduce the term of the loan as option number two. And what that means, if you have a 30-year fixed mortgage and you have 27 or 28 years or 24, 25 years, or basically anything, any term which would make sense based on an analysis, you could reduce the term from a 30 to either a 25, 20, or a 15-year loan. And what that does at that point, the end result there is that you would be reducing the term, of course, which means you'd be reducing the amount of interest that you pay over the term of the loan. And based on your monthly payments, a significant amount of the monthly payment is going towards principal versus interest, as opposed to a 30-year, where for the first number of years on the loan, most of your monthly payment is going towards interest. So the shorter the mortgage term, the number one, lower the interest rate, importantly, and number two, again, reduce the amount of interest, of course, that you're paying over the term of the loan. Sometimes what that entails is people's payment going up ever so slightly, but over the course of the loan, it could potentially mean $100 to up to a couple $100,000 in interest that is saved over the period of time compared to a 30-year loan. So those are two of the three reasons. The other reason people refinance is to do what's called a cash out refinance. And what that means is, depending on the equity in the home, if there's enough equity, you can actually not only take what you owe on the current mortgage plus the closing costs into account on the mortgage, but you can take additional cash out of the equity from the home to pay off any sort of debts, loans, cars, anything that you'd like, home improvements, people do it a lot for. And what that does is it allows you to borrow money on a mortgage, which these days is the only tax deductible interest that is out there, in addition to a home equity line. But depending on the interest rate, as I said, and an analysis, it will be determined what would be the best thing for everyone as an individual. So those are the three reasons why people refi, the three different types of refinances. It's a rate and term refi, which is where you keep the same term of your loan. So if you have a 30-year fixed and you stick with a 30-year fixed, the main goal and the end result is that you're reducing your payment. Could be by as little as $100. It could be up to $600 or $700, depending on how high your interest rate is and how much of a mortgage balance is still outstanding. Number two, just to recap again, is you can reduce the term of the loan to reduce the interest that you'd be paying over the course of the loan. And the third scenario involves the cash out, where you would take some of the equity out, up to 80% equity, and pay off any balances on any debt you may have, or again, for home improvements, put it away for a child's education, any number of reasons that you so choose to do that. And you'd be borrowing again at a very low interest rate, considering we are pretty much at historical lows, as I mentioned before. Different people have different needs, as I just said, based on that. And it's pretty simple for me to do an analysis based on where your current terms are, as far as how much time you have remaining on the current term of the loan, current interest rate. Sometimes there's also an ability, if you were to have an FHA mortgage, which always has mortgage insurance associated with it, refinancing into a conventional loan and either reducing the mortgage insurance or eliminating it completely, depending on the equity position again. In order to do a conventional mortgage without mortgage insurance, you would need to have 20% equity or more in the home to do that. Whereas on an FHA loan, regardless of the equity, or what we call the loan to value, there is mortgage insurance on that loan regardless. So these days that we're seeing in this ever-changing world, our guidelines have changed, restrictions have increased due to what's going on in the financial world, including the stock market and oil, and specifically mortgages. It's a very volatile environment at this point. And we're made aware of that on a daily basis by getting updates on emails, or updated emails, excuse me, as to terms and conditions and guidelines changing. One lender actually just last week came out with a universal guideline where, regardless of it's an FHA mortgage or a conventional mortgage, on a purchase transaction, there needs to be a 20% down payment and a 700 credit score minimal in order for them to do a loan. That's one of the bigger lenders in the country, actually, that just implemented that. So there are things that have changed, and I want to get into that a little bit also. What's going on now is underwriters, the people who underwrite and make the decisions on the loan, have to adhere to certain guidelines these days, slightly different from what it used to be, where right now there are a number of lenders that are requiring documentation to be signed at closing, stating that you are aware or unaware of your hours being cut, any sort of a furlough situation, losing your job, et cetera, to the best of your knowledge at this point. What also is being done, since unfortunately a lot of people are in that current situation, what all lenders are doing at this point is requiring the most recent pay stub from the most recent week, just to make sure that the income level is still where it was when the file was originally underwritten, and of course to make sure that you are still employed. So that's very important, and that's one of the major changes that has taken place over the last number of weeks. So people's financial situations certainly are a lot more volatile than they have been, and therefore extra precaution is being taken on the lender's side. So, that's something to be very, very much aware of. So what's going on also, in addition to that right now, is people want to reduce their expenses. So that is the reason, again, the number one reason why people typically do the rate and term, and why that's the most prevalent and most popular reason for a refinance. So if someone actually has bills that are accumulating at this point and they have a higher rate than what the going rate is currently, it's a good way to offset those additional expenses by reducing your mortgage payment. So depending on the situation right now, as I said, rates are pretty much at historical lows, in the 3% to mid 3% range on a mortgage with someone with decent credit right now. But every situation is different depending on the credit score, the loan to value, the size of the loan, etc. So those are all factors that are taken into consideration when a file is underwritten, whether it gets approved or not. So the current market conditions, as I said, are really, really affecting a lot of things right now. But the one good thing that we are seeing from this, if there is anything, is that the rates are at very, very low, almost historical lows, as I mentioned before. As far as what's involved in a refinance, documentation is still required, meaning we still need to collect pay stubs and bank statements. However, there is less information as required on a refinance versus a purchase transaction. So if you're homeowners, you know what it was involved with that. But there are costs, of course, associated with the refinance. The advantage of refinancing your loan as opposed to your original purchase is that on a refinance, again, a lot depends on the equity position, but you can have the opportunity, as probably 99% people do, of rolling your closing costs into the mortgage amount to eliminate or reduce significantly the amount of out-of-pocket expenses that you would have to incur, as opposed to a purchase transaction when all of the closing costs have to be paid out of pocket. So that is an advantage there as well. For a typical buyer, typical purchase scenario, you're looking at refinancing closing costs being anywhere from 50 to 75% of that. And again, the difference being that those costs can be included into the mortgage amount and not paid out of pocket. So the general rule of thumb on a refinance, for the true cost of a refinance, I'll get into that in a moment, the true cost of a refinance, meaning an appraisal, the credit, fees for title and closing, you're looking at generally about $3,000 to $4,000 for an average loan amount in the tri-state area. New York being a little bit different, where there is the mortgage tax that has to be paid, but there's something called the SEMA that is done to reduce that significantly, and that we can get into that discussion at another time. But the closing costs in New York are higher than other states in the other two states in the tri-state area. Now, again, the question I always get, well, does it make sense for me to refinance? What are the general rules of thumb in regards to refinance? Again, that all depends on the individual. When I got into this business in 1991 and rates were almost at 10%, the general rule of thumb was if your interest rate can be reduced by 2%, that was the typical guideline where it would make sense. I don't think there are many people these days that have a mortgage of 9 or 10%, but people that are in the high fours, mid to high fours, possibly up to 5% at this point. Generally speaking, anyone above 4.25% interest rate at this point, it's worth taking a look at. again, to look at the overall picture to see if it makes sense. So what I was just referring to a moment ago with closing costs of the $3,000 to $4,000, those are the actual true costs of the loan. What also is included or excluded from that, but included in the total, is prepaid interest, which depending on the time of the month that you close, and also escrows, which at this point, most of you who have loans, probably 95% of people out there have loans where they are being escrowed for your taxes and for your insurance. So that is in addition to the closing costs, but whatever your current lender is holding right now comes back to you in that regard. So whatever's being held in escrow in your current escrow account comes back to you within 30 days. And the additional benefit of refinancing is you get to skip 1 month's mortgage payment. So that also helps and factor that into the equation as well. And those are all things that we do at Benchmark and that I do for all of my clients, just to look at the total picture, the entire picture, to make sure that this is the right decision for you folks to make. As I said before, the old rule of thumb was 2% back in the early 90s. Now there's no quote unquote general rule of thumb. It's a matter of looking at what your needs are, where your current interest rate is, and what your new interest rate would be, and either the amount of savings that you will can expect on a monthly basis, or once again, the need to do a cash out and get cash and figure out where the payments would be with that. And again, the other option, as I mentioned, is reducing the term of the loan, which saves interest over the course of all the years. So that is basically the current market situation in regards to refinancing, the reasons to refinance, the approximate costs of refinancing as well, and again, what you need at this point to be approved, which again is to have a current job, not being furloughed from your job, not being on unemployment, and also very important right now to keep in mind that anyone that has decided to take the forbearance program, okay, they are also ineligible at this point to refinance. So that is something to keep in mind. It sounds like a wonderful idea if you can skip a few months' mortgage payments. There are a lot of caveats to that, which I can answer questions on if anyone has questions in regards to that. But anyone who has decided to take that forbearance plan and take advantage of that, unfortunately right now is ineligible for a refinance. So that's something that has come up a lot over the last couple of weeks in discussions and questions that I get from clients and potential borrowers. So very important to do that. If I also can leave with a couple of words of advice in regards to that program. There is a lot of misinformation out there currently, and in regards to how the forbearance program works, it depends on who is servicing the loan, who owns the loan. So what I always recommend to people these days is to contact whoever is servicing your loan at this point and ask them what the policy is for the forbearance, because there are a couple of different options right now. The one option that makes sense, in my personal opinion, is what they first were considering doing, which is adding the 3 months onto the back end of your mortgage. Meaning on a 30-year loan, which is 360 months, your term would actually be 363 months because you wouldn't have paid the 3 months when the forbearance starts. That is, in my opinion, if you need to do that, that is the only way you should go about doing so. The other option, which I want to bring to your attention, which is also very important to consider, if most of the lenders out there are following this, unfortunately, what the situation is, it's a 3-month forbearance. However, what people don't realize, come month 4, not only is your payment for that current month due, the payment for the 3 prior months is also due. So that's not something that is getting a lot of publicity. It's not being discussed much because, in my personal opinion, and speaking with people all day, if you lose your job, if you're furloughed, if your hours are cut, if your spouse is in the same or similar situation, if one of the 2 of the borrowers are, or 3, whatever the case may be, if you can't afford to make your current mortgage payment due to losing your job or, again, reduction in hours or being furloughed, how in the world are you possibly going to be expected to make 4 payments at once? So again, my recommendation is, unless you have to do it due to those circumstances that are unforeseen and unexpected, don't do it. If you are still employed, if you are still able to make your payments, again, my opinion. But if you are considering doing that, again, the most important thing to do is to contact your current mortgage servicer and find out what their particular policy is, because there's nothing right now that is universal across the board. Every lender, every servicer has different policies in that regard. So please do yourselves a favor. If it's something you are considering, contact them first, contact me, just to see if there's a better way around the situation as well. And that was the purpose of discussing the different options of refinancing that are out there right now. There's one other option, which we can discuss at another time, but for folks who are 62 years of age or older and have equity, again, in their homes, and that's obviously very important, regardless of the times that we're in, but especially now, anyone 62 years or older can take out what's called the reverse mortgage. And that, again, is a story for another day, but people, if you've heard of that, if you're over 62, what it does is eliminates your current mortgage payment altogether, where the interest accrues on the back end of the loan as opposed to paying down your interest on a monthly basis as a conventional loan. So that's, again, a story for another day, another topic, but that is the other type of refinance that is available as well at this point. So last thing I wanted to just cover, again, in regards to the word I've often used during this discussion, which is the equity. There are a number of factors that play into someone qualifying for a loan and the type of interest rate that you're getting, and that's what's considered your debt to income ratio, credit score, and loan to value. The other scenario that people sometimes don't realize, if you put 10 or 15% down on a conventional mortgage when you purchased the home a number of years ago, and you still have mortgage insurance on there, and even if your rate is close to where the current rates are, you can attempt from your current servicer to get them to eliminate your mortgage insurance if you do have the equity of at least 21%. If not, the other option would be to, again, refinance to eliminate that mortgage insurance as well. And that's for a conventional loan. So for a lot of people, even though they might not be saving significantly on the interest rate or the monthly savings, when you factor in potentially saving $100 to a few $100s a month just by eliminating the mortgage insurance, or in some cases by reducing the mortgage insurance because you have built up the equity over X number of years, that it would also be a reason for the refinance, to lower your rate slightly, and again, to eliminate or to eliminate altogether, or to reduce the amount of your mortgage insurance, or a combination of the two. So I'll take questions if anybody has questions in regards to anything that we discussed. Clarence, if there's something that I missed, please, let me know, and I'll be happy to address anything if you think that I didn't cover everything.
So thank you for this. I definitely appreciate it. We do have a few questions. just to reintroduce myself, Clarence Cunning. I'm a New York State licensed realtor. I'm helping you make moves and for your real estate needs here. So one of the questions we had was refinancing credit card debt. Is it a good idea to refinance your credit card debts, I'm assuming here, before purchasing a home, or I guess they're saying consolidate debt before they purchase a home?
Well, listen, it's always good to eliminate high interest debt. Um, so my answer to that is depending on the situation, but generally speaking, if it's not going to affect your down payment at all, the answer is definitely yes, if you have the funds available. Um, what what often occurs if people are putting 5% down or 3.5% or 3% down on a mortgage, chances are they don't have a lot of extra funds to be using to pay credit card debt. If someone's putting more than that down, let's say they want to put 25 or 30% down for argument's sake, and they need to pay down some of the debt to qualify for the mortgage because they're carrying a hefty credit card balance, then we would certainly make the recommendation to do so in order to qualify for the mortgage. And in addition to that, if they are carrying debt, even if they do qualify for the mortgage, I would sometimes recommend that if they're putting at least 20% down as opposed to 25%, take that 5% difference and pay off your credit card debt, or as much of it as you can, because mortgage interest is the only deduction besides property taxes where you get a deduction at this point on your taxes. So it serves two purposes. You're getting a deduction, number one, and you're paying a lower interest rate on the mortgage, number two, and it eliminates the debt, which allows people to sleep a lot better typically in the evening, knowing that they're not carrying $20,000, $30,000, $40,000 in credit card debt. So that is all goes into the analysis based on each individual. But if I had to give a blanket answer, the answer would be yes. If you have the ability to pay down credit card debt before a purchase, yes, to absolutely do so. And again, that is one of the more popular reasons why people refinance with a cash out refinance, to pay off debt more so than the other reason, which again is to do some improvements to the home for your child's education, et cetera, because again, you're paying off high interest rate debt with low interest rate debt, which is tax deductible. So the answer there as a general rule of thumb is yes.
Okay, thank you for that. So another question we have is they want to shorten, they have 11 years left on the mortgage and they want to shorten their mortgage, their term.
Mm-hmm.
So what ways do you recommend doing that to shorten the term?
Well, if they have 11 years left on either a 15, 20, 25, or a 30, generally speaking, unless their rate is at a ridiculously high level, they're not going to benefit much by refinancing due to the fact that, generally speaking, the shortest loan term is based on a 10-year fixed. Now, they can also do an adjustable rate, which are not that popular these days because fixed rates are very low, but they can go down that road. But those loans are generally based on a 30-year amortization period. So they're going to, chances are, depending where their interest rate is and depending on the original term, that cannot make sense. But I would say, generally speaking, if you have 11 years left on your term, unless your goal is to reduce your payment significantly by going to a longer term back to a 20, 25, or 30, probably something that I would not recommend generally speaking.
Okay. Would you think about, I know we talked about this before in our private conversations about like velocity banking, we can use HELOCs to pay the principal down a little faster.
I'm sorry, you cut out there for 1 second. I'm sorry.
You can use HELOCs or home equity lines of credit to pay down the principal and then reduce the term because you knocked down the principal?
Well, in other words, how HELOCs generally work, and for those of you who don't know, HELOC stands for a home equity line of credit, and there's also a home equity loan, which is a fixed rate. Home equity line of credit is an adjustable or variable rate. Generally, when people take that out, it is for a term of 10 years interest only, where you're only paying interest. You have the ability or the option to pay down principal anytime you'd like, but generally speaking, it is interest only for the first 10 years. People that want to, again, pay off debt, who want to have money set aside for their child's education, want to purchase a vehicle, whatever the case may be, within, they can do whatever they want to do with it, with the funds. But if you're sitting on a very good interest rate, if you've refinanced in the last couple of years and you're in the threes and the low to high 3% range, and you don't want to incur closing costs on a new refinance, generally speaking, a home equity line of credit is a good option. The only potential downside to that is, again, they are variable in interest. So with rates being very low right now, it is a good option. 3, 4, 5 years from now is the unknown, of course. We don't have a crystal ball to determine where interest rates are going to be at that point. So we don't know. But if you're sitting on a low interest rate and you have the term of the loan that you would like, and you do want to pull some equity out of the home, a home equity line of credit is also an option for you, dependent upon how much money you need. Again, dependent upon your current situation. Sometimes it makes sense just to refinance the loan altogether, but if you're talking about getting an equity line for $10,000, $15,000, $20,000 in that neighborhood, generally speaking, you'd be better off with an equity line to avoid incurring the additional costs that come with the refinance, because the costs on those are very, very low typically.
But in terms of just shortening the mortgage, you can use it to pay the principal down and pay it back off and pay it down again. You're not
Oh, you can. Oh, sure. You can always, in New York, New Jersey, tri-state area, many states actually, I don't know the exact number, but most state, or many states at this point, I should say, don't have what's called the prepayment penalty, if that's what you're referring to, meaning that you can pay down either on the first mortgage or an equity line. You can pay down principal whenever you'd like to without facing any penalties whatsoever. Again, many states have implemented that over the years. Used to be many years ago, depending on the type of the loan that you had received or requested, they required some sort of a prepayment penalty for the first couple of years. And the reason for that was if you were going to hold on for the loan for a very short period of time, the lender or the mortgage servicer would not be in it long enough to make any profit, which is, of course, their right to do at that point. So if you were going to hold on to the mortgage for 6 months and pay it off, it's not worth it to any lender to make that loan, which is why prepayment penalties were part of the lending process many, many years ago, and in some states still are, depending on the program. But generally speaking, a Fannie Mae, Freddie Mac, or FHA loan will not have a prepayment penalty associated with it, generally speaking.
Okay. For people buying homes now, I know that the job situation can be tenuous for many people, where you can be fine, and at the closing you can lose your job. So I know in some situations the loan servicers come back and look and see what your current employment is.
Mm-hmm.
So if you're in that situation, you lost your job, you're using your job obviously to pay your mortgage. What can you do? What options do you have in terms of working with the bank? So you want to be a good guy about it, but you lost your job.
I mean, you're talking about a situation right now, which I had mentioned earlier. The things that are being done these days to protect the lenders, protect the mortgage companies from that, which is requiring a most recent pay stub. So for example, when I'm taking a new loan, we ask for the most recent 30 days of pay stubs. And as long as the loan closes in a reasonable amount of time, and these days, by the way, the refinances, we're closing, believe it or not, less than 30 days. A lot of the major national lenders out there are so inundated right now dealing with the forbearance situation, dealing with all of the volume that they've taken in. They're sometimes taking 60 to 90 days for refinance, which is way too long, especially in this environment, which has tenuous employment and volatility in all of the markets. So we're turning those around in literally less than 30 days. That said, what the major change is when I take an application initially, we take the most recent 30 days of pay stubs, as I mentioned, and as long as the loan closes within a reasonable amount of time, we do not have to update pay stubs. That said, the current environment for the protection of everybody, of the lenders, is that in addition to doing a verification of employment just a few days prior to closing, which is always done anyway in every situation, regardless of the pandemic, is we are requiring the most recent pay stub. So if I have a pay stub from you from a month ago, whereas if we were closing on a loan this week, that would be fine. But now we're requiring, and every lender is requiring, the most up-to-date pay stub, again, to make sure that you are still employed, to make sure that you haven't had any sort of reduction in your pay. In addition, I read something just this morning where many lenders are making you sign a form at closing stating to the best of your knowledge that you are not expected to be furloughed or lose any, have any reduction in your hours, or worst case, lose your job over the foreseeable future. Now, of course, no one has a crystal ball that can predict that, but that is what many lenders are doing right now just to protect them at that point down the road. So to your point, Clarence, yes, if someone knows that they are losing their job next week and want to close today, we can definitely see that coming back to haunt people down the road if they sign these forms by stating that to the best of their knowledge that they are not going to be unemployed or employed at a lesser salary than they had been making previously. So that's a very good question.
All right. I guess the point of my question was they're saying after the fact. They'll say a week after you could have called the HR, hey, Clarence, we love you, you're great, but some of our funding dried up. We got hurt too bad in this COVID situation, and we have to terminate you.
Okay.
So what happens there? I know they have some look backs for the.
Well, yeah, but again, which is the reason why now these forms are coming into play. And this is literally just within the last couple of days I've seen this. So to the best of my knowledge, because this is very fluid right now, to the best of my knowledge, as long as you are currently employed, making the same income that you're making upon the mortgage application, and have no indication whatsoever that, again, either you're going to be losing your job or your status is going to be changing, meaning furloughed or being full-time and going to part-time. As far as I know, again, with this being a very fluid situation, as far as I know, you're not doing anything wrong at that point unless you are aware that one of those situations is going to take place, and which would reduce your ability to make the mortgage payments based on the initial information that you were given to the loan officer and to the underwriter.
So another scenario, and I'm going to throw a little bit of a curve at you. So let's say we close today, right? We find out you lose your job Monday.
Mm-hmm.
It's an FHA loan. Would I be able to get a forbearance in that situation where I just got in the house and pretty much lost my job, but I get it for 3 months to see if I can kind of.
Well, first off, your first mortgage payment isn't due till the following month anyway.
Uh-huh.
So in that situation, if you are furloughed up until that point and you have the month in between and you're able to make the payment, then continue to do so. I always recommend to people in situations like that to call the person who originated their loan, who they did the loan with initially, and get advice, because as I said, right now things are so fluid, and everyone hearing about this forbearance is anticipating that they are going to be having 3 months added to the back end of their loan, when, as I said earlier in the discussion, that might not be the case, where you might be responsible to make your 4th month payment in addition to the 3 prior come month 4. So to answer your question, if you closed today and had no idea that you were losing your job or hours were cut or anything like that affecting your financial situation, you're none for the worse at that point due to the fact that you weren't made aware of it. So can you go on the forbearance plan at that point? Yeah, I believe anybody that has a change in status can do so. I've even gotten calls from previous clients over the last couple of weeks when this program was first announced, that have not lost their jobs, that have not had any financial hardship, but want to see what the program was about, to see if they can basically take a 3-month vacation from mortgage payments. So what I told this one gentleman in particular, as a matter of fact, who makes a very good living and has no reason to actually skip the payment, I said, call whoever's servicing the loan. And again, because everyone is different these days, find out if they are going to tack on to the back end of the loan the 3 months that you weren't going to pay, and then make your decision at that point. But as I said previously, I highly discourage anybody, unless they really have the need, to go the forbearance route, especially if their payment is going to be due. Especially if their 4 payments are going to be due at the end of the 90-day forbearance period. So I always suggest to either call the person who originated your loan to start with, get advice from that person, call me. I can certainly give you advice whether I did your loan or not. And then the next step would be calling the servicer after our conversation and seeing what their policy is. And then you make an educated decision based on what the potential ramifications and the results of the conversations are. Good question.
Good. Yeah, good answer. That's a really good answer, because that situation really can pop up, especially now especially with the whole situation with you had the pandemic loans to small businesses. People weren't able to get to the funding. So unfortunately, you're going to see some pretty large losses across the country in terms of businesses and salary and just livelihoods altogether. So those are real possibilities right now, unfortunately. And it's, you may not get that much help, and you don't know when phase 4 is coming to see if they'll refund that particular program or not, or how much they'll fund it, or larger small businesses like, I don't know the right name, but some larger restaurant chains that have thousands of restaurants, they're still considered small business. Right.
Sure.
They get to it first, which they probably will, because they have the expertise, they have the lawyers and everything else. You can really run out of money quickly again. So
yeah, there's no question. There's no question about that. And again, this pandemic, which is affecting everything in this country and everyone in this country, whether it be directly or indirectly, we'll be facing a lot of challenges down the road. And people do have the concern of, how am I going to make this payment, or what am I going to do now? Everyone or most people are in a very similar situation. No one is feels very stable at this point, I would imagine, in their jobs. People I've been speaking to, many industries that were teetering previously, teetering on the edge of bankruptcy, retail businesses, certain restaurants at this point, if they can somehow survive through this, my hope is that most of them, or all of them actually, will be able to survive once this is over. But they're talking about reductions in the capacity of restaurants, and everything right now. What I'm getting at is everything right now is so fluid in every scenario and every business, and including mine, Clarence, and yours, of course, and the sales of homes. And it seems to be changing on an everyday basis right now. So it's very hard to really know what's going to happen from one day to the next. I've been telling clients for the last month or so that are refinancing, refinance, will get you closed as soon as possible. There's no reason to wait, because what I'm telling you today might not necessarily be the case 3 days from now if guidelines change. So if you're ready to close and you're currently employed, and once again, don't have any indication or knowledge that your financial situation is going to change, then yes, the sooner that you close, the better, because guidelines are changing and volatility is affecting guidelines, and just close sooner than later is my advice at this point.
Are you seeing big changes in requirements for refinancing? Because I know some of the larger lenders, I know the initial mortgage requirements changed. I know like Chase, Bank of America, and I think Wells Fargo, they all went up to about 720 and 20% down for to purchase. But would that impact refis as well?
Well, yes and no. I mean, there are certain lenders. Chase, for example, was actually the first one, to the best of my knowledge, that changed and updated their guidelines more conservatively and being more restrictive. Where on a purchase, it would be a 700 credit score and 20% down. They were the first ones that implemented that policy. On a refinance, the only thing that I've seen right now affecting the refinance market is, again, the restrictions as far as a loan that was let's say a questionable loan for being approved 2 or 3 months ago. If the person's debt to income ratio were high, but they had a very good credit score, good job history, all the factors that we consider when it comes time for an approval, if they would have no problem typically. If that same person right now had a much lower credit score, but all of the other criteria remain the same as far as their income, the job stability, and everything else, but their credit score went down, that's where we're seeing the difference right now, because there doesn't seem to be much of an appetite right now in the secondary mortgage market, meaning where mortgages get sold to, whether it's Fannie, Freddie, or investment banks, whoever it might be, in bulk and in bundles. They are getting more conservative. And what we've seen is that, yes, they'll still do the loans, but a month ago, where let's say the interest rate might have been 3.25 on that same situation, right now, that credit score, that interest rate is going to be I've seen anywhere from 1/4 to 0.5% higher, due to the credit score being lower and the pricing differentials being significantly modified, significantly altered, I should say. So yes, it is affecting that as well. But again, generally speaking, we do not have the minimum 20% guideline or 700 credit score for a purchase, or needing 20% equity in order to refinance. So
There's collaterals involved, I guess, so it makes it a little bit easier for them.
yeah, absolutely. Right. And that's why they were doing it, because, there is the potential for, again, no one knows, no one has a crystal ball or can predict the future, short-term or long-term, certainly. But the bottom line is right now is, due to this pandemic, what's going to happen to the real estate market? Are houses are we going to have a situation where the housing market is going to be affected from a value standpoint? Is it just going to be where there are fewer homes on the market? Nobody knows. I mean, this is all anything that anyone tells you at this point is all speculative because no one knows the answer. But the one thing I do know is that, yes, we've seen a little tightening of the guidelines in regards to credit. So yes, the minimum credit scores, although they've gone up ever so slightly on our end, not to the 700 minimum as a lot of the larger lenders are doing, but at this point, your rate might be or will be more than likely a little bit higher than it would have been a month ago if you had the same credit score due to the risk factor that the lender feels that they're taking based on the issues that we discussed, based on the criteria. So that's a very good question. And I can give you that answer. But again, a lot of it is hedging their bets, basically, due to the fact that we don't know where the market is going to be. So I'm sure they put a lot of thought into this before and looked at data and saw that anyone with a credit score lower than 640 or 650 with a higher loan to value is certainly more likely to have their loan go bad or not being paid, as opposed to someone who has a 760 or 780 credit score that has 30, 25% equity in their home. So that's why they made these adjustments recently.
And it's the last question too. I know it's getting late in the hour. So would you recommend people who are kind of borderline borrowers for mortgages to try to go ahead and get it out the way, get a house now from your standpoint of financing? I know there's some projections in real estate in New York where I was on a call the other day where we were talking about how New York City prices may come down a little bit because some people who have the ability to leave may leave New York or leave denser parts of New York, especially with after this COVID situation, because you want to get away from people or as many people as possible, but still be in New York. So there's, the idea is that people kind of make a flight to like the Nassau or Suffolk counties or Westchester or, the Orange or Rockland counties to get away from New York City, where you can still get to New York City reasonably, but be away, so you can kind of be away from people. So would you recommend to people of kind of borderline, you have the 650 credit, your debt to income ratio is like a 46 or something like that, or you can explain something like debt to income ratio. And would you recommend to go for it now, or maybe wait and see what happens and maybe not have the opportunity to buy a house if, with the
my opinion right now, it's funny, I just had a discussion with someone over the weekend on the same subject actually, is right now things have changed, as I said, depending on your perspective, dramatically, not so dramatically, depending on your perspective and where you fall in the range of qualification. Personally speaking, I think if anything, that the guidelines are going to get a little bit tighter the longer we wait. So if someone is on the fence as far as purchasing a home right now, I would recommend that they do it. I can't see for the near future guidelines easing at this point. I mean, again, when this pandemic hopefully is, whether it's a vaccine, whether it's a cure, whether it has the spread has been eliminated, whatever the case may be, I don't see anything changing for the better as far as guidelines in the very near future. I think if anything, they're going to continue to get a little bit tighter. Again, that's an opinion, it's speculative, but based on what we've seen happen in the last month, we started off where only certain things were changing, a couple of guidelines. Now, as of last week, as you mentioned, Chase came out. They were the first ones to come out with the minimum down payment and higher credit score. Many of the big lenders followed suit. So I can't imagine the guidelines being loosened up at this point. Again, down the road when we see stability in the markets and with the COVID hopefully being under control sooner than later, yeah, things will probably soften up a little bit. But I think if people are on the fence right now, my recommendation would be, if they're able to qualify now, to move forward with that. And I think in that same regard, I think people who are looking to sell currently might be a little more flexible or negotiable, knowing that there aren't as many people going to see their homes right now, if at all, and they might have the need to be out of their house in 30 days or 60 days for whatever reason. So, that said, yes, if I had to say, my recommendation would be yes. If you're on the fence right now, now would be the time, I think, to take advantage of the guidelines being just a little bit tighter, as opposed to down the road where they could get significantly tighter.
All right. Thank you for that. And I appreciate everyone who's joined today. I hope that this was informative for you and that this will help you in some way. I've put Ricky's contact information on the link and live here, so you can reach him. His phone number is there, his email is there. So any question that you may have, you can definitely reach out and he can answer them for you. He's licensed in all 50 states. So if you want to,
48 states.
48 states, I'm sorry. So what, Alaska and Hawaii,
Well, no, if someone wants something in Hawaii, I'll make sure we get licensed, as long as I can come visit the property personally.
Okay, so you can go surfing. So
And Alaska in the summer.
Alaska in the summer, okay.
Right.
So we can, he can definitely help you. Do you have any questions? Even if it's not something that he's necessarily facilitating himself, you have questions, please ask, because I've had other clients have asked questions, and he gave them great answers in terms of what they can do, what options they can have. So don't sit there and suffer in silence. Don't sit there and lose your home. Don't sit there and lose your condo or your property. Reach out, ask someone, say, hey, what can I do? And these people that you can trust, even if you want someone more local that you can maybe meet with, whatever, we can definitely refer you to people who are maybe more local, depending on where you are, that you can see them face to face. If you want to see people face to face at this point, virtually, we can do that for you as well. So if you have any questions, please feel free. You can DM me. You can hit my numbers. It's all over the place. You can please follow my Facebook business page, Instagram, and Twitter. There's more information about what you can do, how to improve your home, financing, that kind of thing. And that'll be great. So next week, we'll probably have some more information about some different things. We'll probably talk about divorce and how that impacts mortgages and credit, because you might see a lot of that coming up, unfortunately, as people being close to each other this long, but you might see that too. So we're going to talk about that and some other subjects in the future. So definitely please like and share if this has been a help to you. And if you have any questions and topics that you want to discuss in the future, please let me know, and we'll talk about those. And
If
Ricky,
I
have
can
any
just,
last word?
Yeah, number one, thank you, Clarence, for this opportunity. Folks, just to shoulder on what Clarence was saying, I've been doing this for almost 30 years. No question is a stupid question. Sometimes I get people that are a little embarrassed to ask questions, thinking it's something that they should know. I am here. I am always available. Whether you're local or not local, I'd be more than happy to answer any questions for you pertaining to anything in the industry. I'm pretty well versed across the board. If anybody is contemplating making any sort of a move, or seeing if a refinance makes sense, possible reverse mortgage makes sense, again, I'd be happy to respond and speak to anyone as long as anytime you need me. Anyone who is looking to sell their property or looking to possibly purchase right now, Clarence is an amazing agent. His integrity speaks for itself. He's extremely helpful, extremely knowledgeable. And, again, thank you for the opportunity, Clarence, for putting this together, and for giving the opportunity for all these folks to hopefully be educated a little bit more on the subject.
All right. Thank you. And our thoughts and prayers are with anyone who's lost any loved ones or friends in this pandemic,
Yes.
and people currently going through it. You know, we're definitely with you, and we're praying that that they'll recover safely and they'll be safe. So thank you very much, and have a good one.
Thanks again, Clarence. Goodbye,
All right.
folks.